guys, and welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're going to talk about volatility skew. It's been a crazy few days in the market. We couldn't have picked a better time to talk about volatility in general. But first, before we get into skew, let's just review what we learned last week with volatility. So we know that volatility is an aspect of extrinsic value. It can increase and decrease based on the option price increase and decreasing. So again, it's not a factor that goes into the pricing model, but it is a result of option prices increasing and decreasing. And because of that, because you can buy and sell puts and there's different markets for those puts and calls, basically volatility skew takes a look at that and gives you a general direction as to if there's a skew or not. So we've got our volatility skew here. So we're going to look at puts on the left side, calls on the right side, and we're going to have our strike price at the middle. So we're going to consider that to be the at the money strike. So when we layer on the normal skew, so if there's not a skew at all, you would theoretically see that the right side should be symmetrical to the left side, or the calls should be trading for the same values as the puts. So in this market, basically there's no skew either way. It's basically a neutral market where there's no bias to any side. So after some of the most recent crashes, this skew doesn't really exist anymore. Now we have a normal market skew, which has the puts trading a little more richer than the calls. So when we layer on the next slide here, we can see that a normal skew has that distorted view of the option premium table here. So you can see that the puts hold their value the further they go out of the money. So again, for puts, when you're below the stock price, that's out of the money, because a put allows you to sell shares at a certain strike. So if you can sell the shares below the stock price, that's out of the money and worthless. And for calls, it would be above the stock price, because calls give you the option to buy shares. So if you can buy shares above the market, no one's really going to exercise that, so it's out of the money. So you can see as you go out of the money on the call side, the value tapers off very quickly because of this normal volatility skew. And when you're looking at the puts, the value holds their own as you go further out of the money. Now, let's talk about why that is. So with a normal volatility skew, you'll see that puts are trading richer than calls in general. So if you look at the market right now, based on the current activity, the market's been all over the place. I think we hit a high of over 70 today for the E-mini S&Ps, and I think they closed right around flat. So we went down 70 points in one trading day, which is crazy. We've seen over 100 points the other day we were down. So the market is super volatile right now, and that's indicative in the option pricing. So when there's a volatility skew or a normal market volatility skew, puts are trading richer than calls because, again, people are hedging their position. So if we assume that most of the market is long stock, if we're hedging our positions, there's two ways we can do this. We can buy puts, which would outright hedge the entire position, or sell calls. And again, since volatility is a result of option pricing, if I'm buying puts, that's going to increase the put price, and if I'm selling calls, that's going to decrease the call price, which is why you see this normal skew or this normal market skew. So back in the day, you might have seen no skew at all because people weren't aware. There wasn't a heightened sense of awareness of the market like there is right now with how volatile everything is. Everyone's got their eyes on their portfolios. Everyone's looking at the market, and because of that, people are skewed to the puts in terms of puts being richer than calls, and people are selling calls against their position, which reduces the price of calls. So this is essentially a normal market skew because people are buying puts, selling calls to hedge their long portfolios. So if we look at a reverse skew, it's a little bit different. So this skew has been attributed to stock market crashes because people were aware of their shares and now they're hedging. And hedging by long puts or selling calls is two ways you can do that. But a reverse skew, we're going to start off again with no skew at all. So you see that the graph is very symmetrical on the right and left side. But when we throw on the reverse skew, you can see that it's basically the opposite. So with a reverse skew, the calls would be trading richer than the puts. Now, you might think to yourself, why would this ever happen? How could this happen? There's a lot of different reasons, but basically we would attribute it to maybe a stock market crash up, or if the stock market is crashing up, or whatever underlying you're looking at is crashing upwards, where there's a ton of speculation to the upside, so people are buying calls, which is going to increase the price of the calls, or they're getting rid of their hedges, so they're selling out of their puts, or they're just selling puts to collect premium. Those are two ways that bullish speculation can occur, and because of that you might see a reverse skew. So again, two ways that reverse skew can be completed is basically by with the bullish speculation here, and if we're buying calls, that's going to increase the option price of the calls. There's a ton of speculation here, and also selling puts. So if people were long puts on their portfolios and now they can see that the stock price is just going up and up and up, maybe they decide to close out of that. Or if they're trading like us where we're selling puts, then that's going to reduce the price just as well, and people are collecting premium. So these are two different skews that you might see in the market, and a reason for each of them. So again, today the stock market went from up 70 points to flat. So if you look at the market right now, if you look at SPX or SPY specifically, if you look at the money options, you can see that just out of the money for the puts, they're trading much richer than just out of the money than the calls. And this is basically true for all of the expirations. It's especially true the further out you go. But it's very evident and clear. You'll see that most underlyings trading right now are going to have the normal market skew. They're not going to have this reverse skew because everyone is speculating to the downside. There's a lot of fear in the market, so the normal market, the volatility skew is going to be in place. This reverse skew, again, would only really take place if the market is crashing up or if there was anything else in place. So it's a lot harder to pinpoint reverse skews, but the normal market skew would be a skew to the downside because most of America or anyone that's trading is going to be long stock and they're hedging their position in a certain way. So let's get to the takeaways here. So some takeaways for volatility skew. The very first one is normal market volatility skew can be attributed to past crashes. So if you have the ability to look at options data before crashes, you can see that there probably wasn't as much of a skew as there was today. Also, as people become smarter investors and because the option market has grown in terms of liquidity and awareness just in general, people understand that buying a put would hedge against long stock completely, or selling a call would underhedge against stock. So just that transaction, the more puts that are bought, the higher the option prices are going to be, and the more calls are sold, the lower the option prices for calls are going to be. So that creates the skew where the puts are trading higher than the calls for a normal market skew. Volatility skew is a result of long stock hedges. So again, most people, especially institutional strategies, institutional traders, they've got a ton of shares in different underlyings. If they're hedging against that stock, they're going to be buying puts and selling calls. Reverse market volatility skew is rare, and sometimes you can attribute it to crashing up, or if there's a ton of speculation to the upside and not much speculation to the downside, you're going to see a lot of people trying to ride that wave of the potential bull move, and they're going to be buying calls, and they're going to be getting rid of their long puts, so they're going to be selling their puts, which is going to reduce the price of that. Or there's going to be people trading like us where we're just selling puts to collect premium as the underlying goes up. And last but not least, usually the result of speculative call buying. So that is, again, for reverse skew. And again, that can be attributed to stocks crashing up or just bullish speculation. So this has been Volatility Skew. We've closed out everything that we've had to talk about in terms of the basic understanding of volatility. I hope you enjoyed it, and we've got, if you want to take a look back to last week, we've got a bunch of different volatility segments, and I also made a guest appearance on the webinar of July 31st of this year. So me and Ryan discussed IV rank, and we've got these awesome graphics again. So if you want to take a look, any of these are available for download if you just click on the magnifying glass at the top of and you can find the show, Mike and his whiteboard, or the webinar for that specific episode, and you can click on the slides button, which will be in the bottom right corner of the video player, so that will be available to you. So tomorrow we're actually going to be off. We've got Truth or Skepticism in here again, but we will be back on Thursday, so don't miss it at 3:15 p.m. Thanks so much for tuning in. If you've got any feedback at all, shoot it over to support@doe.com or support@, or you can tweet us at DoeTrading, at DoeTraderMike, or at. Thanks again, and have a great night.